do want you to read the warning though. Listen, everybody should trade what they can afford to actually trade. This is not a one size fits all. We're not giving advice for people directly. It's more like general advice, and it doesn't take into account your objections, your financial situation, or your needs. Take a second, read the warning, and we'll move on to Jeff, which I'm excited about. All right, there we go. That was nice. That was a buzz killer, wasn't it? All right, this will get you excited. It should get you excited. Another one. Today's been a lot. Listen, today's been a lineup. I got certain guys and girls I like to listen to, and today's been a great lineup of people that some of my favorites are speaking today. And then I got to know some new people too. So today's been good for me. Jeff Tompkins is literally one of my favorite guys to listen to in an educational standpoint. Jeff is a professional trader with experience in stocks, options, futures, and he currently serves as a hedge fund manager at Altos Capital, which means he doesn't just trade his own money, he trades other people's money too. He founded Altos Trading to help others achieve financial freedom through consistent and profitable trading strategies. Now, Jeff has been trading since all the way back in 1999. And some of you weren't even born then. I don't believe that. Let's make everybody feel good today. All the way since 1999. And he developed a set of highly tested strategies that have consistently produced results regardless of market conditions. Altos Trading's primary focus is to teach these disciplined strategies that Jeff has come up with to individuals who are interested in becoming more consistent and successful traders. One more thing, Jeff is actually on vacation right now with his family in Hawaii, but still came in because he said he would do this and kind of double booked himself, left his wife on the beach, came inside, took off his Hawaiian shirt, put on a dress shirt. Ladies and gentlemen, Mr. Jeff Tompkins. Jeff, how are you?
Hey, great. Thanks. Great intro. Thank you.
Thanks, buddy. How's Hawaii?
That's fantastic. Obviously, weather's beautiful. Beaches are beautiful. Did some snorkeling yesterday and saw all kinds of cool fish and sea life. So it's been great.
Beautiful, beautiful. Well, we're looking forward to the presentation. Rodrigo and I are going to turn off our cameras. We're going to give you screen share, and it's all up to you, buddy.
All right, thanks. By the way, I do have a Hawaiian shirt on, but I'm not on camera. I'm not going to be on camera, so you have to take my word for it. You'll have to take my word. But hopefully you guys can see my screen okay?
We can. You're good to go. Looks good.
Okay, awesome. All right, well, welcome everybody. I apologize, I don't have all my fancy equipment with me. I'm on my laptop, so hopefully the audio is okay here. But in any case, welcome. Again, thanks for joining me. Today we're going to be talking about how to fix losing options trades. Just out of curiosity, how many options traders do we have out there? You want to pull up your chat box. Just curious how many people in the room trade options or maybe are considering trading options. All right, Oliver, yeah, got it. Oliver's the first one to chime in. Cool. This is going to be great. Thanks for Ron and Michael. Rich, a lot of options traders in here. Awesome. Sonali, great. Well, you're gonna get a lot out of the session today because we're going to be talking about how to fix losing options trades. I could have followed that up, I guess, with how many people have losing options trades, but I think it's safe to assume we all face those from time to time. So what we're going to focus on today and work on accomplishing is how to deal with those losing options trades, because in fact a lot of them can be fixed or adjusted in ways that can mitigate losses or actually turn a losing trade into a profitable trade. So that's going to be the focus of our session today. I know John just put up a nice disclaimer, but I'll go through ours real quick just to make the attorneys happy. We of course know trading securities and options involves risk. Prior to buying or selling an option, an investor must receive a copy of characteristics and risks of standardized options. Of course, need a broker to trade securities and options and must meet suitability requirements. We'll go over some results together today. A lot of them are real world results, including real money results, but just know that anything that I share doesn't guarantee future performance. All right, so we got that out of the way. So I want to start out with a little interactive exercise. And this might seem a little odd at first because it's not necessarily directly related to trading, but you'll see the thread here in just a second. So again, pull up your chat box and let me know what you guys think these two common household products have in common, WD-40 and the Nintendo gaming system. Pull up your chat. Do you guys have any idea what these two have in common? I'll give you a clue. It's not spraying the WD-40 into the Nintendo system to get the game to go in, because I'm sure a lot of you have tried that. I've tried it. Assuming you were alive when Nintendo, the original one came out, you probably have some younger people on here who may not recognize. But anyone have any idea what the commonalities? Michael says both are publicly traded. All right, that's probably true. Any other guesses? Kind of a tricky one. Oliver says WD fixes things and Nintendo takes away time. Actually, that's a good answer. Push a button, get an output. All right, there's a lot of good answers in here. Both operate with a single press. These are actually all great answers and probably most of them true. Daniel says profit opportunity. Daniel, you're kind of almost on the right track there. So I'm going to tell you what the commonality is. Both of these products have actually failed miserably, believe it or not, because they're so successful today. Believe it or not, Nintendo actually failed miserably when it was first launched. So of course we know it today as a gaming company that launched this whole home gaming era, but it didn't start out that way. In fact, their first console, the Famicom, had to be recalled after only a few months. And then Atari came along in the mid 80s and just left the whole gaming system in a mess. It just wasn't going well, right? And when we think of personal gaming, home gaming today, it's hard to believe. Nintendo eventually launched their NES system, but it barely sold. So they had a lot of difficulties. So what turned it around for them? Well, those two little guys on the bottom corner of your screen, Mario and Luigi. So they launched this whole new model with Mario and Luigi as their centerpiece, right? So this is actually what really got people hooked on the gaming system. And by the end of '86, these two little characters really changed the whole American gaming system forever. So they just made a little tweak or adjustment to their business model that completely turned it around. Well, WD-40 is also an interesting case scenario. So if you've ever wondered how WD-40 got its name, it comes from the fact that it was the 40th attempt to create a degreaser and rust protection solvent. So this actually failed 39 times before it became the most widely used home lubricant, right? So it didn't start out that way. It took them 40 attempts to get it right. Okay, so once they got it right, they of course packaged it in the aerosol cans and introduced it way back in '58, long before Nintendo was around. But imagine if they'd given up after 39 tries, right? We may not have WD-40 as we know it today. So that's the commonality between these two products, is they both faced failures, right? And a lot of companies go through failures before they reach success. Well, it's the same thing with trading, right? We virtually all go through a series of failures before we reach success. So what really separates failure from success is the ability to make adjustments to our business model. In this case, make adjustments to our trades, because we're going to face failure, but we need to have a backup plan to achieve success. So there can obviously be a lot of causes of failure in the trading world. Ultimately, it's losing trades that wipe out profits from our winning trades that result in the low success rate of traders and investors. Of course, there's psychological and capital availability, uncertainty in the markets, all these things that go into that. But those things result in losing trades, and that's really our biggest overhead that we face in the trading business, right? Today, most brokers are commission-free or very low commission. You really just need a computer and an internet connection to access the markets. So the overhead as it relates to most businesses is quite low. Of course, you need trading capital, risk capital. And so the good news is, yes, we're going to face failures, but I've found in my personal experience and my experience with our members at Altos is up to 75% of the losses traders experience can actually be fixable and avoidable. And that should get you excited, right? If you can actually fix a bad trade and turn it around, mitigate a loss, or even turn it into profitability, imagine the difference that could make for you. And so, yes, losses are simply a cost of doing business in the trading world, but a lot of them can be avoided and even turned into profitable trades by making a few simple tweaks. And that's what we're going to go over today. So imagine if you could take a commonly traded option strategy like the iron condor. Let's say an iron condor on the S&P 500, the SPX, that didn't go well at first, right? In fact, it was down 3,900 bucks, let's say. But then you made a tweak or an adjustment to the trade and turned it into a $2,400 winner. Or how about another commonly traded option strategy, the credit spread? Imagine a credit spread on the QQQ that's down $580, where you're able to make an adjustment to this particular trade and turn it into a $620 winner. Or how about a naked put? One of my favorite strategies is selling puts for income. How about a naked put on Sienna, CIEN, that's down $730, where you're able to make an adjustment to this trade and turn it into a $540 winner? Well, these aren't hypothetical examples. These are actual examples where we had issued recommendations or alerts to our members, faced a losing trade scenario, and made an adjustment to these and turned them around into winners. Okay, so these are some of the things that we're going to be going over today, and I'm going to show you exactly how we do this. All right, this is I don't very often share personal account information or screenshots from my accounts, but when I do it to demonstrate what's possible from real world trading, not hypothetical. So this is a screenshot from my personal TD Ameritrade Thinkorswim account back on August 24th, 2015. And I live in the Mountain Time Zone, so I don't know if you can see in the bottom right of your screen there. This was taken at 7:36 a.m. on that day, 6 minutes after the market opened. So market opens 7:30 a.m. Mountain Time where I live. All right. So what's going on here? Well, I've got, I don't know, somewhere maybe around 10, 12 positions in my account. What happened on August 24th, 2015? It was the day of the flash crash. So the markets tanked right at the open. And I think the Dow was down like 1,000 points. It was like an unprecedented crash. And so they dubbed it the flash crash. Well, all of these positions in my account were short puts. So I sold puts on various stocks. Now, if you're familiar with the strategy, when you sell a put, you want the stock to either remain stagnant, it could move down some. There's a degree, margin of error and safety there, but ultimately you really want the stock to go up. So that's obviously, this isn't good, right? The market's crashing. Every stock in my portfolio is down, and you can see that down, as much as, let's see, what TNA was down almost 15%, right? So others 12%, 10%, 8%. These are huge percentage drops. But then if you look at my P&L, I'm up $7,609.92. So this is a strategy where when the market tanks and stocks that I've sold puts on have dropped dramatically, I should be losing money, but I'm not. I'm up $7,600 plus 6 minutes into the open. So how did I do this? Well, I did it with a very specific type of adjustment to these options trades that I'm going to show you. Okay. So believe it or not, there's an adjustment to fix virtually every bad options trade. And that's one of the things I love about options is the flexibility to to make adjustments to trades, right? It's a very unique asset class, and it gives us that ability if we know how to do it. So over the next 45 minutes or so, I'm going to reveal a few of my most effective adjustment techniques to fix losing options trades. And I'm going to show you exactly how I accomplished what I just revealed on the day of the flash crash back in 2015. So we're going to talk about like how to take a losing credit spread, execute a delta neutral hedge, and turn it into a winner, or a naked put and executing a horizontal roll and taking that losing naked put and converting it into a winning trade. Or you can also take single leg options trades like a long call or a long put and execute what's called a transition to a vertical spread and take that losing position and adjust it into a potential winning position. So I wish we had enough time today to go through every option strategy and every adjustment. We don't, unfortunately, but I'm going to go through some of the more commonly traded option strategies and some of my most effective adjustments. All right, so a little quick background on myself before we get into the fun stuff. So I have 20 years of experience trading the stock options and futures market. Actually, probably need to update this slide. It's like 24, I think now. I received my professional training at Morgan Stanley. So I interned at the trade desk, and that's where I really got an inside, exposure to the institutional trading world. I quickly transitioned into trading for myself because that's, obviously what we all strive to do is to become self-sufficient, profitable traders. The road was bumpy, right? It took me a good decade or so to reach that level. All right, so the learning curve is steep, but I'm here to tell you that it's achievable. All right, you just need the right path, the right tools, the right education, and the right strategies. And then, of course, you need a backup plan. You need a way to make adjustments to your trades when they don't go as planned. So I ended up founding Altos Trading about 8 years ago. Again, I need to update this slide because I think we have somewhere like 50 to 60,000 members in over 100 countries across the globe. So we have a really diverse group of members who trade different asset classes, different strategies, different markets. And we have a very robust group of options traders, a lot of whom came to us not knowing how to adjust trades. And so it's been a real pleasure and it's a rewarding experience to watch people who struggled with options trading and then learn to make adjustments and see things really turn around for people, right? And see them go from being inconsistent to consistent. So that's really what we strive for at Altos Trading. And as John mentioned, I'm also a hedge fund manager, so I manage money for clients at Altos Capital. I won't be giving any personal advice or any recommendations directed to any of our attendees today, but I do manage money for clients. So a lot of what I teach in my educational sessions, like our session today, are actual strategies, methodologies, and tactics that I deploy in my hedge fund. So this is a really unique opportunity to get kind of an inside look into the hedge fund world, right? The world of managed money. So I don't hold anything back. I'm going to be sharing all of this with you. I've also created different algorithms and softwares in addition to strategies. And so these are all things that we offer to our members. All right. So again, thanks for being with me today. And I hope you can stay with me to the end because you're going to get an incredible amount of information and I think benefit out of our time together. So by the end, my goal is to help you discover how to fix losing options trades and even turn them into winning trades. And I'm going to reveal some of my top trade adjustment tricks to reduce risk, increase profit potential. And whether you're just starting out, or maybe you've been trading for a long time, or maybe you're a professional, maybe you're a money manager, right? Regardless of where you are, I completely agree with what John said. Is you can pick something up from everybody. After 24 years of trading, I'm still learning. I learn every day, and so I applaud you for being here today and putting the dedication into becoming a better trader. So this is really must-have information for today's markets. So let's start out by talking about some specific options related topics. So selling options versus buying options. This is often a question we get, which is better? Well, one or the other might not be better, but there are advantages and disadvantages to both. When we talk about statistics, and I use a lot of statistical models in my trading, selling options tends to have better odds than a casino has over its customers. So if you think about, the Bellagio or the Wynn or, Caesar's Palace, these monstrosities that cost billions of dollars that, don't go out of business, right? They just manage to thrive. Even when, back during COVID, when they weren't getting a lot of travelers to Vegas, right? They're able to withstand downturns in their businesses because they have this built-in statistical edge. So they know as long as people are gambling at their tables, they're going to make money. That edge may not be all that big. I'm a craps player, a blackjack player. If you play them correctly according to the rules, they only have about a 1.5% edge over their customer. With option selling, we can actually get a much higher percentage edge than a casino has over its gamblers. And that's exciting because we know that if we execute it correctly and follow the statistics and have a backup plan to adjust losing trades, that can increase our edge even more. And this is where I get really excited about selling options and having what I call a positive trade expectancy. I know with a high degree of confidence that I'm going to be profitable over a series of trades and over a particular amount of time. Now with option selling, you have 3 ways to win, right? You can win, the stock goes up, the underlying stock goes up, if it stays flat, or it moves against you slightly. Okay, so that also builds in an edge and is one of the reasons I love selling options. It also allows time decay to work in your favor. Time decay is one of the worst enemies to option buyers. We're really building a list of reasons, but kind of a base case for why option selling can be successful when done correctly. There's a lot of variables, a lot of factors when executed correctly can lead to a higher probability of success than buying options. So there's more room for error. It's typically easier to adjust option selling trades as well. All right, so that's also a reason that I gravitate toward option selling. So as I mentioned, and as I revealed in my screenshot from my TD Ameritrade account, one of my core strategies is selling puts for income. Okay, I do a lot of different types of option selling, trades, but this is one of my core strategies. All right, if you're familiar with selling puts, or if you're not, I'll give you a little bit of, kind of a high-level overview of what it is. So a naked put, often referred to as a short put, is when you sell to open put options, right? And for doing that, you collect a premium or a credit in your brokerage account for entering the trade. So it's kind of the inverse of option buying, where you pay a premium and then you have to wait and see, that premium has to increase. And in order to book the profit, you've got to sell the option premium at a higher price. Well, it kind of works the opposite with option selling. You collect the money up front, it actually gets deposited into your brokerage account when you execute the trade, and the goal is to keep it, right? And this is really powerful because when you, if you're an option buyer, there's what I call the trader's dilemma. When do you get out? And there's a higher likelihood that fear and greed are going to get injected into your, your trading and your mentality, your approach, and that makes it more difficult to be successful. With option selling, when you collect the premium, you don't have to guess what your profit is going to end up being if you have a successful trade. You already know it at the start, right? Now, things might change. We might have to adjust. And here's the really exciting part. And I'm going to show some examples of this. There are cases where we can actually make more money than we would have otherwise made if the trade had just worked out the way we expected it to in the beginning. So how cool does that sound? Because usually when things go bad, we end up in a worse situation down the road. But with adjustments, things can go bad and you can actually end up better off than you would have been had nothing gone wrong. It sounds kind of counterintuitive, but I'll show you how that is. So again, going back to selling puts, when the stock rises, okay, and the put options that you sold expire out of the money, you get to keep the entire premium you collected when you sold them. So here's kind of a general example. Let's say we sold puts on ABC stock that's trading at $100 per share. You sell to open 10 of the 95 strike contracts for $250 a contract. Let's say these expire in 14 days. Since each contract controls 100 shares of stock, you receive an immediate deposit of $2,500 in your brokerage account. Now, as long as that stock closes above your strike price, $95 at expiration, you keep the entire $2,500 premium you received when you initiated the trade. Sounds pretty cool, right? And the way that we do, we at Altos Trading and myself sell options, this can happen like 80 to 85% of the time. But then there's, that 10 to 15% of the time where it doesn't go that way. It doesn't go as planned. And that's what we're going to address today, right? Now, there's some common misconceptions about selling puts. One is that a naked put is extremely risky, right? It's uncovered, it's not hedged, and it has a high degree of risk. Okay, but in fact, selling puts for income has a similar risk profile to buying stock or writing covered calls. So if you look at a risk graph of a naked put, a short put, relative to a covered call, they're virtually identical. Yet, virtually nobody would tell you a covered call is a risky strategy. Now, that doesn't mean that naked puts can't be extremely risky, right? There's a lot of factors that really matter here, right? Capital allocation, risk management, risk tolerance, all of these things that when disobeyed can lead to risk. So that can happen with any type of trading style. But when done correctly, it can be an incredibly consistent method for collecting income from the options market. In fact, it's how Warren Buffett often acquires stock. He sells puts, collects premium for doing so, and then if the stock doesn't trade below his strike price, he continues to do that until he's assigned shares, right? Now, we're not going to be focusing on selling puts for the purpose of acquiring stock today. We're purely looking at it as an income-based strategy. We don't intend to take assignment of shares of stock. Now, let's talk about what happens when things go wrong. Because inevitably, with any strategy out there, and don't ever let anyone tell you otherwise, things are going to go wrong at some point, okay? So we always have a primary exit strategy. And in the case of this particular option strategy, that's when the put expires out of the money and we keep 100% of the premium. So that's our initial goal, okay? And again, over a series of hundreds and hundreds of trades going back about 8 years, this happens about 85% of the time for us, okay? So that's a pretty high strike rate. But again, what about the 15% when it doesn't work out the way that we intend or hope? We have a secondary exit strategy. So we need to make an adjustment to the trade. And one of our favorite adjustment strategies often results in even greater profits, as I mentioned. Again, it sounds counterintuitive, but I'm going to demonstrate it. So let's talk about how to adjust a losing short put. There are two core techniques that we use. One is rolling. So rolling involves closing out our initial trade, the short puts, and opening a new trade at a further out expiration. Same strike price, same number of contracts. And ideally, we want to do this for an equal or greater credit or deposit into our account. All right. And it's this one adjustment alone that's led to 306 net wins over 8 years with 0 net losses. Okay. So that includes trade adjustments. So about 85% roughly of 306 trades required no adjustment. The other 15% or so did, but we were able to dig ourselves out on every one of these losing trades and turn them into profitability. Second type of adjustment that we're going to be talking about, and we're going to apply these to other strategies here in just a minute outside of the short put. Delta neutral hedging. So in order to transform a naked put right into a delta neutral position, you have to buy to open enough at the money or near the money put options in order to completely, or as completely as possible, offset the positive delta of your existing short put options. And by executing this adjustment, if the stock should continue to fall, if you didn't make the adjustment, you would continue to lose money, right, on a short put. And there's no, it's an uncapped loss. I mean, until of course the stock goes to zero. But by using this particular adjustment, you can profit on the put options that you purchased. And because of the delta hedging, it can offset losses on the ones that you sold and actually outpace them. All right. So this is, and I'm going to talk a little bit about this here momentarily. This is more of an aggressive adjustment strategy. So we kind of split our adjustment strategies into conservative and aggressive, and they really have to match what's going on in the market. So going back to my portfolio of short puts from the flash crash of 2015, how did I post a $7,600 profit on 10 short put positions that were down as much as 15%? All of them were down on the day, using the delta neutral hedging adjustment. So let's walk through what I did here. I'm going to give you the formula. So I started out with a short put. I had sold a put. It's a single-legged options income strategy. Now, when the stock starts to drop aggressively, what I can do is I can buy a hedge. And the key here is when I buy it, it has to be delta neutral. All right. So delta is basically one of the options Greeks that measures the movement of price in the option premium relative to a $1 move in the underlying security. All right. And this is something you can get on your options chain, on your your position screen on your account. So it's available. You don't have to calculate it, but I'm going to give it to you. So to get the number of to get the delta neutral hedge, we take the number of contracts in our original position, we multiply it by the delta times 100, and that's going to give us our position delta. But again, your broker statement, or sorry, your broker account will provide this to you. Now, we then divide the at the money option, so the strike price that's closest to the current underlying stock price, by the position delta to get the number of contracts to buy. Okay. And that's going to give us a delta neutral hedge that can profit on a decline in the underlying security. Exactly what happened here for me back in the flash crash of 2015. So here's kind of a generic example. Okay, we've got an options chain. We're looking at the put side of the options chain. And let's say we sold the 58 strike puts. Okay. Well, if you're familiar with what options chains look like, you'll know that by looking at this, that it tells us this stock has dropped below 58. So the 58 strike options are now trading in the money. So that would result in most likely a loss on our position. Okay. So what we don't want to have happen when we sell a put or when we execute any bullish option selling strategy. We don't want the underlying asset to drop below our short strike. But let's say, okay, here it did. What do? Well, first we get our position delta. So here the delta is 0.59. Applying the calculation that I just gave you, we get a position delta of 590. All right. Again, we're using 10 contracts as an example. Now we're going to take the at the money strike. That's the 57 strike, the price that's closest to where the underlying asset is trading, and we're going to take that delta, which is 0.48, and apply the calculation to it. So that gives us a DNH, a delta neutral hedge of 12.29. Well, we can't buy 12.29 contracts, so we just rounded the nearest whole number. So in order to neutralize the delta on this short put, we would need to buy 12 57 strike puts. And that's how you apply a delta neutral hedge to a short put. Now, this can be applied to vertical spreads, multi-leg spreads. We're going to look at that as well. But that's how I was able to accomplish this back on the flash crash of 2018. I delta neutral hedged each of these positions as the market was crashing and was able to book a profit of over $7,600. Okay. Now let's talk about another really effective adjustment technique. Again, the one that I mentioned that we primarily use in our put selling service. Okay, and that's rolling. So let's look at an example, and this will kind of make it clear on what rolling is and why it can be effective. So September 12, 2019, we sell puts on Micron with an August week 4 expiration at the 44.50 strike. And at the time, you could collect $55 a contract for doing that. So let's just, as an example, use 10 contracts. We would collect $550 in credit to our account for executing the trade. Now, the goal is for Micron to stay above 44.50 and retain that entire credit. Now, unfortunately, in this scenario, just within a week or two, Micron rotated lower. So the stock starts trading down and it actually goes down below 44.50 per share. So on September 27th, we would execute, so this is when the stock goes below 44.50, right? We would execute a rolling adjustment. So the position would be in the red. It would be losing money. And in this case, that was $1.19 per contract. So we went from 55 per contract to $1.19, right? So that would be our debit for closing out the original short put position. We roll out to October week 2, all right? 44.50 strike puts, okay? For that, we collect $216 a contract. So notice what's happening here. We were debited $1.19. Well, first we were credited 55, but then we were debited $1.19. We rolled out, so we haven't added any nominal risk to the trade, right? We're just extending the time horizon. Same number of contracts, same strike price, but we're collecting now $216 per contract because we've extended the expiration. And there's both extrinsic and intrinsic value to the options premium, right? So that's where the net credit comes from. Now on October 11th, right? And by the way, I just noticed there's a typo in here. That should say September, not August on that first line. Sorry about that. So on October 11th, those contracts to be closed at a 52-cent debit. Now remember, we collected a 55-cent credit when we put the trade on. So that's $55 per contract, $550 for 10 contracts, $1,100 for 20, whatever your position size is. We were debited just slightly less than what we initially were credited, right? When we put the trade on. Doesn't sound too great. And believe it or not, Micron never even really recovered. In fact, when this trade could be closed on October 11th, the stock was sitting at 43.59. So it was almost $1 below the strike that we sold. But what happened? On 10 contracts, it would have resulted in a profit of $820. Now remember, the profit potential was $550 when we put the trade on. How did we make $820 from 500, initial profit potential of 550? Well, the rolling adjustment allowed us to do that because it created a net credit when we closed the initial position, opened to the new position. And there's a lot of nuances to this we don't have time to get into, but implied volatility is a huge benefit to rolling, right? Because when assets decline in price, implied volatility goes up, which increases the option premium and allows us to execute this adjustment for net credits. Now, when stocks stabilize, so they don't necessarily have to go back up, implied volatility drops, and that benefits the short put position. And that's how this is able to be accomplished. So it works because it allows you to stay net cash positive while taking advantage of decreases in implied volatility and increases in the underlying share price. So pretty powerful stuff, right? How many losing trades can you take and then end up in a place where you made more money than you would have made if the trade never encountered any trouble, right? That's a really powerful thing. And the silver lining is, as we just looked at in this example, and by the way, that example was a real example that we sent out to our members at Altos. And that silver lining is that, like we looked at with Micron, you don't have to recover past or short strike in order to be profitable. Since we're staying net cash positive with the rolling adjustment, the net credits over time can offset the debits. Again, it needs to be done correctly. It's not to say it's a fail-safe or foolproof way to overcome all losses. So there are things to consider when executing these, and we'll talk a little bit about that here in just a moment. But let's look at some other strategies. How about credit spreads and iron condors? They're very popular option selling strategies created by buying cheaper options contracts and simultaneously writing an equal number of more expensive options contracts. So a credit spread is an option spread that you receive cash or a net credit, and that's why they're often referred to as credit spreads for executing the trade. And the credit to your options trading account is why such spreads, as I said, are known now as that. So an iron condor is simply the combination of two credit spreads. So it's a bull put spread and a bear call spread on the same underlying security with the same expiration. Now, why do I love these types of option selling spreads so much? Well, unlike buying, for instance, a single option like a call or a put, we don't have to hit a bullseye, right? With most option buying strategies, you've got to really hit a bullseye. You've got to be right on your timing and so many other things to be successful, right? Here we can throw darts all over the dartboard, right? And we can still be successful, especially when we incorporate trade adjustments. So how do we adjust a losing credit spread or iron condor? Well, let's go back to delta neutral hedging. Again, I mentioned that delta hedging can be applied to any option strategy. It's just the way that we apply it. It's a little different for each type of strategy, right? So in order to transform a credit spread or iron condor into a delta neutral position, if either the short put or the short call is breached, we close half of the contracts at the breach strike. And this can help offset losses and even produce a profit if the underlying continues to move past the spread, right? And that's the problem with credit spreads and iron condors. If you don't adjust them, you're left with an inverse or basically an unfavorable risk reward skew, right? So we can have a series of many successful trades that can easily be wiped out by one bad trade because the risk on a per trade basis is much higher nominally than the reward is, right? So that's to emphasize how critical it is to be able to adjust these types of trades. So let's look at an example. June 15th, we executed an iron condor, so a bull put credit spread, a bear call credit spread. There's 4 legs to the trade on the S&P 500 index, the SPX. At the time, you could collect $110 credit per contract, right? So again, let's just use 10 contracts as an example. Now, 10 days later on June 25th, the SPX rotated lower. It was selling off pretty heavy, right? And it breached the 27.25 strike puts in the spread. That would have resulted on 10 contracts in a $3,900 loss in the position, right? It's a floating loss, right? The position's still open, right? We haven't closed it. Instead, we're going to adjust it. So the next day, June 26th, we executed delta neutral hedge. So we close half of the 27.25 strike puts. Okay, so that's going to neutralize our delta. Now on the next trading day, June 27th, this position could be closed for a $240 per contract profit, turning a $3,900 loss on 10 contracts into a potential $2,400 profit. Right. So the S&P continued to drop. The worst enemy of the credit spread or the iron condor, right? Just blowing right through your spread. Now, the good news is these are vertical spreads, so our risk is capped, but this would be a scenario where we'd have a max loss if we didn't adjust the trade. All right, so delta neutral hedging can really work magic when the underlying continues to move in the direction of your breached vertical credit spread. And that's, again, a real world example of one that we sent out to our members a few years ago. All right, let me see, how much time do we have? Kind of running short on time. I'm going to skip this example. It's another delta neutral hedge example, or I'll kind of run through it really quickly. It's Apple. Okay. If we sold a bear call credit spread here, around the 125 strike, there's obviously a level of horizontal resistance here where it might make sense to sell the call spread above that level. But as you can see, in mid-December, Apple just blew right through it, right? So this is, again, an example where we'd have probably a max loss on a bear call credit spread, all right? But this is another way to adjust. And again, sorry, I'm going to run through this quickly just for the sake of time, but it's also a delta neutral hedge, just a different way to execute it. So using 10 contracts as an example, where we sold the 125 strike and bought the 127s to hedge for a credit of 59 per contract, so $590 on 10 contracts, right? Well, what we can do is we can actually plug in a long position at a strike right in between our short and long strike in the credit spread. Okay, so we'd plug in a 127 strike. We can use it. We don't have to use an equal number of contracts. We can vary the contract size, the position size, but I don't want to go any more than what I have in the original spread. So the most aggressive move would be to plug in 10 contracts in between our original 10 contract credit spread. All right. Now, the position was down $560 when the adjustment would have been needed to be, executed, right? But what happens? Apple, as you just saw on the chart, continued to move up, right, against our spread. The P&L on the original spread would have been $1,385 in the hole, right? But what happened with the hedge? $6,300 on 10 contracts. So the delta hedge outpaced the loss in the spread. Okay, so the net result at expiration would be a profit of $4,915. Okay, so that's a different way to execute a delta neutral hedge, different example. Now I'm going to give you some crucial tips to adjusting trades. As I mentioned before, trade adjustments can be both defensive and offensive, right? So we want the trade adjustment to match the strength of the move and the underlying security. So if the market's in a sharp decline, or in the case of like a bearish position, like the bear calls credit spread we just looked at on Apple, right? If it's moving sharply past our spread or our position, a delta neutral hedge can turn losing trades into big winners if the stock continues to blow through your short strike, right? But if we just get a minor breach, or maybe we have some time flexibility, we're not close to expiration, we can ride this out. Rolling is more of a defensive, less aggressive type of adjustment. So the trick is not just knowing how to execute, right, but when and what to adjust, right? Which level of aggressiveness matches what the market's doing. Now you know that up to 75% of losing trades can be avoidable. So we're still going to have losing trades, but we need a plan to mitigate loss, or even take a loser and convert it into a winning position. Okay. And again, this is how WD-40, Nintendo, so many other companies turn failure into success. They had an adjustment, a plan, right, that they executed to overcome the loss. And there's an adjustment to fix virtually every bad trade. So I've revealed a few of my most effective adjustment techniques to fix losing options trades. We have many, many more. I wish I had the whole day with you guys. I could sit here and just go through lots of different types of adjustments on different types of option strategies, but I wanted to make sure that I shared some of my most effective ones on some of the more commonly traded option strategies. All right, but I do want to invite you to learn more from me. Because of our limited time, I could only reveal so much, and I don't want to cut you off and say, good luck. I want to invite you to learn more about trade adjustments. All right, this is obviously not the money show, the summer summit, but didn't update the slide, I apologize. Okay, so 12 to 15 trade alerts per month. okay, is what we send out to our members for 3 of our top strategies. Okay, our typical holding period is only 14 days, so a couple weeks, right? And 85% of the time, roughly, that's how long we would be in the position. There are times when that gets extended if we have to make an adjustment to the trade. Okay, but there's relatively short holding periods. We have an average win rate of 85% for all services. Okay, and that's without the adjustments on some of those services. We've closed, it's now actually north of 300, 306, I believe, winning trades in our put writer service with 0 net losses. Okay, so that includes adjustments. Here are the results. These are actually real world results that we've issued to our members. 2016, 50 alerts, 10 contracts would have resulted in over a $28,000 profit. 2017, we issued 52 alerts, so about 1 a week, $22,000. 2018, 48 alerts, over 17,000. 2019, 50 alerts, over 21,000. 2020, 37, 28, over 28,000. 2021, 36, over 17,000. 2022, right? Last year was a bad year, right? Last year was a bad year. We just didn't do as many trades, right? Just like 2021, things were starting to look rocky. We're approaching the end of this very long secular bull market. So we scale back on our exposure a little bit. But remember, this is a strategy where we want the market to be going up. Well, obviously it did not go up in 2022. So a testament to the adjustments that we use still was profitable. Okay, so again, this is based on 10 contracts. It doesn't include broker commissions or fees, and it includes trade adjustments. But these are the results that we've experienced over the past 7 to 8 years. We're coming up on 8 years now in this one service alone. Okay, and this is scalable. You can obviously, based on your account size, trade a lower number or a higher number of contracts. Okay, this is what one of our alerts looks like. Okay, so we give you the annotated chart. We give you all of the instructions to execute the trade with your broker. This is an example of an iron condor on TLT. This was a 14-day trade with an absolute return of over 19% and an annualized return of over 495%. Okay. We also issue alerts on stocks. So if you guys trade stocks, we send alerts on stocks as well in this package. So this is an example of one that we sent out on Morgan Stanley. Okay, again, you get the annotated chart, you get all the rationale behind why we believe the trade is poised for success. And if any adjustments are needed, we also send you those. Okay, and again, most of them on average were in these about 14 days, so 2 weeks. Okay, this is an example of a credit spread alert on the triple leverage QQQ. Okay, again, 13-day trade, 21.95% absolute return, annualized to over 616%. All right. So I'm going to go through some of these a little more quickly since we're coming up on time here. Everything that comes with the package, right? We've put a retail value. So if you went to our website and bought all these, services individually, over $3,800 of value in this package. So you get an entire year of our top 3 options and stock alert services. Those come with trade adjustments. We spent about an hour together today where I revealed some of my best trade adjustments. What we've done is compiled this training and included other option strategies, as well as stock strategies and other markets into an online course that's over 10 hours of content. You can watch at your leisure. Normally we sell that course for $997 retail. And we're going to include that in the package so that not only do you get the alerts, but you can continue to learn along as you receive the alerts, along with these strategies, and when we do have to make adjustments to them. The course comes with all, the robust training of other types of adjustments and scenarios where they can be used. You get access to our members only group. You get a member login. You get to learn our trade adjustment strategies, all the others that we didn't have time to cover today. We deliver all of our alerts after market hours, so you don't have to day trade. Okay. Again, you get on average 12 to 15 per month. That's based on market conditions, and that's our average. We guarantee a win rate of 80% or greater, right? So if we don't meet that, let us know, because we don't guarantee that you're going to make money, but that's our win rate, right? That's our benchmark, and we've done much better than that, but that's our baseline. Okay, so we're going to slash the price here big time. So please don't go buy all these things individually from us on our website, because for today only, we're taking 92% off. Okay, so you can get everything you see here for $297. Incredible deal. All right, we limit it to 25 seats for the purpose of giving you guys good customer service and not taking on hundreds of people at one time and sacrificing quality for quantity. So to take advantage of the offer, you can go to altostrading.com/bundle and claim one of the 25 seats for 92% off. All right. Who's it for? Well, we have people from everywhere from beginners to seasoned traders, people who work full-time jobs, which we have a lot of, and we have a lot of retirees as well. And they love it because they don't have to sit in front of their computer during market hours to trade these. All of our alerts go out after market hours. You have that evening, that afternoon, that evening, the next morning before the market opens to execute your trades. So it gives you tremendous flexibility. We have students in over 130 countries of all account sizes, whether you're trading one contract, 100 contracts, traders who want to learn to trade on their own, which is probably a lot of you, right? You're here to learn today, so that's probably a lot of you. But we also have a lot of traders who just want to be spoon-fed. They just want the alerts and to go on about their day, right? And that's fine too. All right. So I won't go through all of our testimonials for the sake of time, but we have thousands of members who trade our strategies and utilize our adjustments and have had tremendous success. We also have a guarantee. So we have a 30-day guarantee because we believe in backing up what we offer. And if you aren't completely satisfied with your results, send us a copy of your statement, your broker statement. We'll refund everything, right? So we're here to help you be successful. That's our goal. That's our responsibility. That's what we're here for. But it's a two-way street. We need you to put the effort and commitment into it. So this is how we meet in the middle. So if you're not successful, then it's really our fault. We'll take the blame and refund every penny. All right. So what happens next? So you're automatically added to our members list for trade alerts and directed to the trade alert membership registration page. Once you register, you're going to receive a confirmation email in just a few hours confirming your access. You get exclusive access to the professional trading series course that I just mentioned in our members only portal. And you're going to get two special bonuses. Again, one is the professional trading series. Comes with all of our top strategies, options, stocks, Forex. It includes training on trade adjustments, chart reading, trade management. Again, valued at $997. You'll get my latest ebook, How to Create Risk-Free Trades. This is a great supplement to the alert package. It goes through money management techniques that can be used along with these strategies to help mitigate loss in your trading. All right, so I ran a couple minutes over. If there are time for questions, I'd be happy to take them. And I'll let John let me know. If I don't get to questions, this is our contact information, support@altostrading.com. You can email us there, or you can give us a jingle on the phone, 800-895-9348. Because so many people are seeing this today, be patient with our representatives. It may take them some time. We do have an answering machine service, so you can leave a voicemail and we will get back to you. So if you're interested in the package and you're worried you're not going to get one of the 25 spots, just leave us a voicemail and we'll make sure that you get your spot. Again, altostrading.com/bundle. So again, here's everything that's in the package. And it's 92% off retail, right? So really unique opportunity. This is for today only. So the offer expires today, and you can still get everything you see, but it will go back to the retail pricing. With that, I really appreciate you guys being here. I hope to continue on with you and teach you a lot more. I want to thank Rod and John and their team for having me. It's been a pleasure. John, I'll pass it back to you, and I can answer any questions if we have time, but let me know what works.